So what is the capital stack? So in simple terms, the capital stack is the underlying financial structure of any commercial real estate deal, specifically in a private equity real estate deal. They call it a stack because it refers to the layers that go into purchasing and operating a commercial real estate investment. It's primarily made up of debt and equity. And it also lets you know who gets paid and in what order and how much risk each layer carries. So knowing the stack is incredibly important when it comes to determining the risk and reward that you're going to make or that any given investment in the stack is made. A simple way to look at the stack, for example, in residential investing, is there are two components. There's the down payment, which is the equity portion, and then there's the mortgage, which is the debt portion. Okay, so the capital stack is usually made up of four sections, and in the following order. At the very bottom is what's called the senior debt. It's a first mortgage, usually provided by a bank, so it's the bank loan. It's paid first in any, uh, I guess, in any distribution of funds, and should it go into any kind of foreclosure or litigation, it's the first one to get paid. So therefore, it's the lowest risk, but it also has the lowest interest rate. Okay. The next one is mezzanine debt, and it's a hybrid of debt and equity. And so what that means is there's a debt portion paid, so there's an interest component associated with it. So as the profits are made, there's an interest paid on a regular basis. But there's also an equity component where usually mezzanine debt has the option to convert itself into equity. So it could eventually own shares in an investment. The key thing about mezzanine debt is it's not secured. Okay. As a result, it's got a higher interest rate, or it earns a higher rate of return than the first mortgage, than the senior debt. Again, because it's more riskier, right? And like I said, sometimes it has the right to convert to equity. And mezzanine debt is usually temporary. Usually mezzanine debt lasts for about a year, and then they do something to buy them out. Usually what's called a dividend restructuring, or they execute and they convert their debt into equity. The next layer is preferred equity, and this is where the limited partners come in. This is where they raise money from individual investors called limited partners in an LP. I say individual investors, and it could also be a company that's in there. Okay, so it's equity investors and it's limited partners. And then finally, the top of the stack is the common equity or the sponsor equity, and this is where the owners or the founders or the general partners come in. Okay, so again, so the lower the stack, or the lower the position in the stack, the lower the risk, but then the lower the return. The higher positions typically earn higher returns, and the result is higher levels of risk. Okay, so here's an example I'm going to walk through of a typical stack. So let's say you're going to be purchasing a $10 million property. Okay, so the bank puts up 50% as the first mortgage and earns 6% return, and they get 6% return on that loan, on that mortgage. Next, you have a second mortgage, which is the mezzanine debt, and that's for 20% of the purchase price. So out of the 10 million, they're going to put up 2 million. And as a result, they're going to get paid 8%. Plus, they have the ability to convert their loan into an equity position. The next is a preferred equity. So you're going to go out and you're going to raise money from your investors, from your limited partners, and you're going to raise 20%, which is $1 million, or sorry, $2 million, 20% of 10 million, and you're going to pay them 8%. Now the trick here with preferred equity is they could also get some carried interest or interest from any profits above and beyond what they get paid at the 8%. And then finally, the common equity, which is your actual investment from the owners, from the founders, from the sponsors, and that's at, let's say, 10%. So 10% of 10 million is 1 million. So in order to purchase this property, the owners have to invest only $1 million, and they arrange for financing from all those other different levels that I just talked about from different debt and equity. The thing about common equity, though, and the sponsors is they only make money after profits, but they usually get paid from other sources. For example, they get paid fees. Sometimes there's an acquisition fee, there's a management fee, and then there's also a carried interest fee or carried interest, which means they will get a portion of interest above and beyond all profits after paying any debt and equity obligations. Okay, and then they also get paid if there is a dividend recapitalization. Okay, so that's how a capital stack looks like in private equity real estate investing.